There's a photograph that doesn't appear in most history books. October 24th, 1929. A crowd gathered outside the New York Stock Exchange. Look closely at their faces. You won't see panic. You won't see desperation. You see confusion. These people don't yet understand that they're watching a crime scene. They think they're witnessing a market correction. They have no idea they're about to become characters in a carefully constructed mythology, a story that will be told and retold for nearly a century, always with the same moral, always missing the same crucial details. The story you learned about the 1929 crash is a lie, not a complete fabrication, but something more insidious, a truth so carefully edited that it functions as deception. The crash happened, certainly. Fortunes vanished. Lives were destroyed. The Great Depression followed. These facts are indisputable, but the narrative connecting these facts, the explanation you've been given for why it happened and what it means, serves a purpose that has nothing to do with helping you understand economic reality. This documentary will show you what was removed from that narrative and why. More importantly, it will reveal how the same mechanisms that turned a market event into a civilizational trauma are operating right now, in markets you participate in, using principles of behavioral psychology that work just as effectively today as they did when your great-grandparents first encountered them. We begin not in 1929, but in 1928, because understanding what didn't happen is just as important as understanding what did. Throughout 1928, sophisticated observers knew the market had detached from underlying economic fundamentals. This wasn't secret information. The Federal Reserve knew. Major banks knew. Wealthy insiders knew. Several economists publicly warned that stock prices had become untethered from corporate earnings and dividends. The price-to-earnings ratios of major companies had reached levels that made no mathematical sense for long-term investors. Here's what you weren't taught. These same insiders who recognized the unsustainable nature of the bubble did not simply exit their positions and watch from the sidelines. They actively participated in extending the bubble, understanding that the greatest profits come not from identifying bubbles early, but from riding them to their absolute peak and exiting just before the collapse. This requires control over information flow and timing, advantages that institutional players possessed then and possess now. The margin lending system of the 1920s allowed investors to control stock positions by putting down as little as 10% of the purchase price. This is presented in most histories as evidence of reckless gambling by unsophisticated investors. But examine who was offering these margin loans. Major banks and brokerages didn't just permit this speculation. They actively marketed it, knowing that each margin account created a built-in forced seller who would have to liquidate positions when prices declined, thereby accelerating any downer. The system was engineered to transfer wealth upward during both the rise and the fall. Consider the mechanics carefully. When you buy stock on 10% margin, you're creating a situation where a 10% price decline wipes out your entire investment. A 20% decline means you owe money. The lender, the institution that encouraged and profited from your speculation, now has a legal claim on your other assets. This isn't a bug in the system. This is the system functioning exactly as designed. In early September 1929, stock prices reached their peak. The Dow Jones Industrial Average hit 381 points, a level it wouldn't see again until 1954. But the peak wasn't a singular moment. Prices fluctuated, creating what market technicians call distribution, a period when informed sellers are exiting positions while less informed buyers are still entering, believing they're getting opportunities. The volume of shares changing hands during this period tells a story that contradicts the official narrative of indiscriminate panic. The selling wasn't random. It was systematic. Large blocks of shares were liquidated in ways designed to minimize immediate price impact, a technique that requires both sophistication and patience. These sellers weren't panicking. They were executing planned exits while maintaining public confidence. Newspapers continued publishing optimistic forecasts. Prominent financiers made reassuring statements. The psychological environment was carefully maintained to ensure continued buying interest while informed participants were reducing exposure. October 24th, the day that photograph was taken, began with a technical breakdown that triggered automated margin calls across the market. When prices fell below certain levels, brokerage firms were contractually required to demand additional cash from margin borrowers or liquidate their positions. This created a cascade. Forced selling pushed prices lower, triggering more margin calls, forcing more selling. The mechanism was automatic, systemic, and entirely predictable for anyone who understood the structure. What happened next is where the official story becomes most misleading. A group of prominent bankers met at the offices of J.P. Morgan and Company. They pooled resources to support stock prices, making conspicuous purchases of blue-chip stocks at above-market prices. This intervention is presented in most histories as a heroic attempt to stabilize the market and restore confidence. That interpretation requires you to ignore what these same bankers did in the days and weeks that followed. The buying was theatrical. It created a temporary rally that allowed additional insiders to exit positions at better prices than they would have received in a pure panic. By Monday, October 28th, the support evaporated. Prices collapsed. The official explanation is that the bankers realized the situation was hopeless and withdrew their support. The alternative explanation, supported by later congressional testimony, is that the support was never intended to stop the crash, only to slow it enough to allow orderly distribution of insider holdings to less informed buyers who mistook the Thursday rally for a buying opportunity. Tuesday, October 29th, saw the largest one-day volume in the exchange's history up to that point. 16 million shares traded. The ticker fell hours behind, meaning investors were making decisions based on outdated information. This information asymmetry wasn't an unfortunate side effect of technological limitations. The exchange had resisted upgrades to ticker technology for years, despite knowing the system was inadequate for high-volume periods. When information matters most, those who have current information possess an enormous advantage over those making decisions based on delayed data. In the weeks that followed, something remarkable happened that receives minimal attention in standard histories. While stock prices continued declining, the actual underlying economy remained relatively strong. Corporate earnings, employment, manufacturing output, the fundamental drivers of economic value, didn't collapse in October 1929. They declined gradually over the following months as the stock market crash created psychological and credit effects that rippled through the real economy. The Great Depression wasn't an immediate consequence of the crash. It was a delayed reaction, mediated by policy decisions and institutional responses that transformed a financial event into an economic catastrophe. This distinction matters enormously. It reveals that the crash and the depression, while related, were separate phenomena with different causes. The crash was a market event, the correction of unsustainable asset prices. The depression was a policy failure, the result of monetary contraction, bank failures, and trade restrictions that strangled economic activity. Conflating these two events into a single narrative serves to obscure the agency and responsibility of institutions that made specific choices in response to the crash. The Federal Reserve's response provides a clear example. Rather than expanding the money supply to offset the deflationary pressure of vanishing stock market wealth, the Fed allowed the money supply to contract by approximately one-third between 1929 and 1933. This wasn't an accident or an oversight. It was policy, driven by a theoretical framework that prioritized protecting the gold standard and punishing speculation over maintaining economic stability. The human cost of this choice was staggering, but it served the interests of creditors whose claims gained value as deflation made dollars scarcer and more valuable. Banks failed by the thousands, not primarily because of loan defaults, but because of runs, depositors withdrawing funds en masse, forcing banks to liquidate assets at fire sale prices. The standard explanation is that these runs reflected irrational panic. But examine the incentive structure. In a system without deposit insurance, the first depositors to withdraw received their money in full, while those who waited risked total loss. Under these conditions, running to the bank at the first sign of trouble wasn't irrational panic. It was a rational response to a coordination problem deliberately created by a banking system designed to operate on fractional reserves without adequate safeguards. The Pecora Commission hearings of 1933 and 1934, led by Ferdinand Pecora, revealed practices that shocked the public and led to major financial reforms. Bank executives admitted to creating pools to manipulate stock prices. Investment banks had sold bonds they knew to be worthless while betting against them. Insiders had used confidential information to trade ahead of their own customers. These weren't aberrations or violations of the system. They were the system functioning as it had been designed to function, only now exposed to public scrutiny under political pressure created by widespread economic suffering. The reforms that emerged, the Securities Act of 1933, the Securities Exchange Act of 1934, the Banking Act of 1933 establishing the Federal Deposit Insurance Corporation, are presented as fixes that prevented future crashes. This narrative serves a crucial ideological function. It suggests that the system was flawed but has been corrected, that the bad behavior was individual rather than structural, and that markets with proper regulation can be trusted. Each of these suggestions is problematic when examined against both historical evidence and theoretical analysis of institutional incentives. Market crashes continued. 1987 saw a one-day decline larger in percentage terms than any single day in 1929. The 2000 dot-com bubble burst destroyed trillions in paper wealth. The 2008 financial crisis required government interventions dwarfing anything attempted in the 1930s. Each crash featured the same basic pattern. Asset prices detached from fundamentals, insiders accumulated positions during the rise, sophisticated participants exited during distribution, and retail investors absorbed losses during the collapse. The specific mechanisms evolved: portfolio insurance, algorithmic trading, mortgage-backed securities, but the fundamental dynamic remained unchanged. Understanding why requires examining the psychology of narrative construction. When a major negative event occurs, humans demand explanation. We're uncomfortable with randomness or complexity. We want simple stories with clear villains and heroes, moral lessons, and preventable mistakes. The financial industry and political establishment had powerful incentives to provide such a story after 1929. The story they constructed assigned blame to individual greed and speculation while positioning institutional reforms as solutions. This narrative deflected attention from structural problems that benefited powerful interests. The average investor in 1929, portrayed as a reckless gambler, was responding rationally to incentives created by institutions. Banks and brokerages marketed margin lending aggressively because it generated fees and interest income. Newspapers published bullish forecasts because they received advertising revenue from financial firms. Economists and academics provided theoretical justifications for high valuations because they received funding and consulting fees from Wall Street. The system created a coordinated message that encouraging speculation was normal, safe, and rational. Blaming individuals for responding to these incentives is like blaming someone for getting wet after institutions convinced them it was raining. The behavioral psychology at work here has been formalized in modern research. Herding behavior, confirmation bias, availability heuristic, recency bias. These aren't character flaws or failures of individual rationality. They're features of human cognitive architecture that evolved to solve different problems in different environments. Financial markets exploit these features systematically. The participants who profit most are those who understand how to manipulate these psychological tendencies while avoiding becoming subject to them. Consider how information environments are constructed during market bubbles. Positive stories receive prominence. Skeptical analyses are marginalized or ignored. Measures of valuation that suggest overpricing are dismissed as outdated or irrelevant. New metrics are invented to justify higher prices. This isn't accidental. It reflects coordinated effort by participants who benefit from sustained high prices. Corporate executives with stock options, investment banks earning fees on new offerings, media companies generating clicks and advertising, politicians claiming credit for prosperity. When the crash comes, the information environment reverses. Negative stories dominate. Panic is amplified. Suggestions of buying opportunities are dismissed as catching falling knives. This environment serves those who exited at higher prices and are waiting to re-enter at lower ones. The transition between these environments isn't smooth or gradual. It's typically sudden, triggered by an event that may be objectively minor but serves as a coordination mechanism, a signal that the rules have changed and everyone should update their behavior accordingly. What happened in October 1929 fits this pattern precisely. The actual triggering events, a few negative earnings reports, some worrying economic data, didn't justify a 50% market decline, but they served as coordination signals. Sophisticated participants had been waiting for an excuse to exit. These signals provided that excuse, triggering the cascade of margin calls and forced liquidations that created the crash environment. Retail investors, lacking the information and analytical resources to recognize the manipulation, experienced it as incomprehensible chaos. The lesson you were taught is that speculation is dangerous and markets need regulation. The actual lesson is that markets are battlegrounds where information asymmetry, structural advantages, and psychological manipulation determine wealth distribution. Regulation doesn't eliminate this dynamic. It formalizes it, creating new categories of legal and illegal behavior while leaving the fundamental power relationships intact. The insiders who profited from the 1929 crash weren't punished. Most weren't even identified. The system that enabled their profits was reformed in ways that made similar profits harder to achieve through the specific mechanisms used in the 1920s, while creating new mechanisms that serve similar functions. Modern market structure illustrates this evolution. High-frequency trading firms now possess information advantages measured in microseconds rather than hours or days. Dark pools allow large participants to trade without revealing their intentions to the broader market. Derivatives markets create leverage that makes 1920s margin lending look conservative. Payment for order flow ensures that retail trades are processed in ways that extract maximum value for intermediaries. These mechanisms are all legal, regulated, and defended as providing market efficiency or liquidity. The psychological dimension has also evolved. Social media creates coordinated buying pressure more effectively than newspaper tips ever could. Options markets allow sophisticated participants to profit from volatility regardless of direction. Narrative construction happens in real time, with trending topics and viral content replacing morning newspaper headlines. The fundamental dynamic remains unchanged. Those who control information flow and understand mass psychology extract wealth from those who don't, but the specific techniques have updated for contemporary technology. What makes the 1929 narrative so persistent and effective is that it contains enough truth to be plausible while omitting the elements that would enable you to protect yourself. Yes, speculation was excessive. Yes, margin lending amplified the crash. Yes, regulation was needed. These facts are accurate but insufficient. They describe symptoms while obscuring causes. The cause was a system structured to enable wealth extraction by informed insiders from uninformed outsiders, using predictable patterns of human psychology and information asymmetry. Recognizing this pattern doesn't require cynicism or conspiracy theories. It requires understanding incentives. People and institutions respond to incentives in predictable ways. When the structure rewards certain behaviors, those behaviors will occur regardless of regulatory framework or ethical guidelines. Financial markets reward those who can identify mispricings before others, exit positions before others, and influence the perceptions of others. These abilities correlate strongly with access to information, analytical resources, and communication platforms, advantages that concentrate among institutional participants. The Great Depression created such widespread suffering that it generated political will for genuine reform. But examine what was reformed and what wasn't. The specific mechanisms that enabled the 1929 crash were addressed: margin requirements, disclosure rules, banking separation. The underlying structure that creates information asymmetry and concentrates advantages among insiders remained intact, and in some ways was strengthened. The regulatory framework created barriers to entry that protected established firms while claiming to protect investors. This is a common pattern in regulatory responses to crises. During the 1930s, as the Depression deepened, an alternative narrative briefly gained traction. This narrative suggested that capitalism itself was fundamentally flawed, that markets couldn't be trusted to allocate resources efficiently, and that extensive government control of economic activity was necessary. This radical critique threatened existing power structures far more than the mainstream narrative of excessive speculation corrected by smart regulation. The establishment narrative you learned wasn't just explaining 1929, it was providing an alternative to more radical interpretations that might have led to genuine structural change. The competition between these narratives shaped the political economy of the mid-20th century. The New Deal reforms represented a compromise, significant government intervention and regulation, but preservation of private ownership and market mechanisms. This compromise satisfied enough constituencies to prevent more radical change while maintaining the basic structure that benefits financial insiders. The story of 1929 as excessive speculation corrected by regulation supported this compromise by suggesting that the problem was fixable within existing frameworks. Understanding this ideological function of the 1929 narrative helps explain why it's taught so consistently and why alternative interpretations receive so little attention. Every economics textbook, every history class, every documentary repeats the same basic story with minor variations. This consistency isn't evidence of truth, it's evidence of narrative utility. The story serves institutional interests by directing attention away from structural advantages and toward individual behavior and regulatory solutions that don't threaten those advantages. Have you ever wondered why financial markets seem so chaotic, why the advice to just buy and hold sometimes leads to catastrophic losses? We're often told that markets are efficient systems for discovering prices and allocating capital. But what if that's not the whole story? What if, instead of neutral platforms, financial markets are actually battlegrounds? Imagine a landscape where different players with vastly different resources, information, and goals are all competing for wealth. In this world, success isn't just about picking the right company based on its earnings. It's about anticipating what other players will do, understanding their biases, and even influencing their behavior. This changes everything. It's less about economics and more about psychology, game theory, and information warfare. If markets were all about business fundamentals, the patient, long-term value investors would always win. But they don't. If it were all about having secret information, insiders would never lose. They usually win, but not always. The real game is much more complex. You're not just analyzing a company. You're analyzing the analysts who are analyzing the company. You're thinking about their incentives, their blind spots, and how they'll react when things get crazy. Let's look at the great crash of 1929. The smart money didn't have a crystal ball showing them Radio Corporation of America's future profits. What they had was a deep understanding of the market structure. They saw the dangerous levels of borrowing. They tracked money flows. They felt the shift in public sentiment, and they watched the political climate. They knew a crash was inevitable. The specific trigger didn't matter because the conditions were ripe. Too many players had an incentive to make it happen. This same pattern repeats throughout history. The 1987 crash? It wasn't about a sudden economic crisis. It was about a known flaw called portfolio insurance that created automated selling spirals, a weakness that savvy players could exploit. The dot-com bust in 2000? It wasn't just that many tech companies had no profits. It was that valuations had become completely detached from reality, creating a massive opportunity for those who knew a correction was coming. And then there's 2008. The story we hear is about bad subprime mortgages. But the real problem was the insane amount of leverage and hidden risk connecting all the major banks. The system was fragile, and those who understood this fragility could either protect themselves or profit from its collapse. After each of these crashes, we get an official story, a narrative that pinpoints a technical problem and proposes a regulatory fix. The 1929 narrative blamed irrational speculation. The 2008 narrative blamed predatory lenders. But these stories serve a specific purpose. They allow the system to continue with minor tweaks, instead of forcing us to ask the hard questions. They distract from the core dynamic of information asymmetry and structural advantage. They keep us from asking whether the basic setup of the market actually serves the majority of people. So, if you're trying to build real financial independence, you need to ask different questions. Forget asking which stock should I buy, or what will the market do next. Instead, ask, what advantages do the big institutions have? What hidden mechanisms can force people to buy or sell? Who is creating the dominant narrative, and what are their motives? What behaviors are being encouraged and why? These questions don't have easy answers or simple formulas, but they give you a framework for seeing the market as it truly is, without blindly trusting narratives built by institutions that may not have your best interests at heart. Your real competition isn't the person next door trading on their phone. It's the sophisticated institutions with massive advantages in information, analysis, and structure, advantages that regulation often fails to eliminate. This changes how you should view common investment advice. Buy and hold sounds great, but it exposes you to maximum pain when the battlefield turns bloody. Dollar cost averaging into an overvalued market? That just means you're consistently buying at prices you'll later regret. Diversification is useful, but it won't protect you when entire sectors are being systematically manipulated. An alternative approach flips the script. It focuses on preserving your capital when risks are high and being aggressive when everyone else is panicking. This means you do the opposite of what institutions often encourage. You don't chase a rising market, and you don't sell in a panic. But this requires incredible discipline. It means developing your own independent way of thinking and having the courage to act against the crowd, especially when the crowd is being led by a carefully constructed narrative. It's not easy. We are psychologically wired to follow the herd and trust authority figures. Institutions know this and exploit these tendencies every day. To resist, you need more than just intellectual understanding. You need true emotional independence. You need the ability to watch others get rich in a bubble and not feel the urge to jump in. And you need the courage to buy when there's blood in the streets and everyone is telling you you're crazy. The few who successfully navigated the 1929 crash had this exact combination of clear analysis and emotional strength. Their stories are often left out of the history books. They saw that prices had lost touch with reality. They understood the mechanics that would trigger the correction, and they had the patience to position themselves for it, ignoring all the social pressure. Their success wasn't luck. It was the result of seeing what most people were paid to ignore. Joseph Kennedy, JFK's father, famously got out of the market right before the crash. His signal? He started getting stock tips from his shoeshine boy. He recognized that when speculation had reached every corner of society, the end was near. Financier Bernard Baruch had been selling his stocks all through 1929 because he knew valuations were insane. These men didn't have secret inside information on companies. They understood market psychology and the structure of the game. Their approach is the polar opposite of what academic theories, like the efficient market hypothesis, would suggest. This theory says you can't beat the market, so you should have just stayed invested through the crash. The incredible wealth that was destroyed by people who believe that idea shows the huge gap between elegant theories and messy reality. This tension still exists today. Finance professors teach that markets are efficient and timing is impossible. Meanwhile, certain hedge funds consistently deliver returns that should be statistically impossible if that were true. The truth is somewhere in the middle. The market is just efficient enough to make it hard for most people to beat it, but it's not so efficient that sophisticated players can exploit repeating patterns driven by timeless human psychology. The 1929 story serves to hide this reality. It suggests the problem was a one-off bout of craziness that new rules could fix. But the speculation wasn't irrational for the people involved, given the information they had. And new regulations haven't stopped new bubbles, because they don't change the fundamental incentives that create them. As long as big institutions can profit from these cycles of boom and bust, the cycles will continue. Just look at the housing bubble leading up to 2008. That crisis happened despite tons of regulations designed to prevent exactly that kind of disaster. Banks had capital requirements and were watched by multiple agencies. Yet, they loaded up on so much risk that they almost brought down the global economy. The regulations failed because the regulators themselves were operating with the same flawed assumptions as everyone else. The agencies were staffed by people from the very industry they were supposed to be policing, and the political system rewarded them for pushing homeownership at any cost. And the narrative that came out of 2008? Same old playbook. Blame was placed on specific actors, greedy bankers, predatory lenders, weak regulations. The solutions were all technical fixes, higher capital requirements, new oversight bodies. But the fundamental structure of the battlefield remained untouched. In fact, the too big to fail banks got even bigger. The government basically guaranteed their survival, encouraging them to take even more risks in the future. A massive amount of wealth was transferred from taxpayers to Wall Street, all justified as necessary to save the economy. This pattern repeats because it works for the institutions. Every crisis creates pressure for reform. The reforms are put in place, but they only fix the last problem while leaving the core power structure intact. The next crisis always comes, just through a different door. And the narrative is always ready to explain it away in a manner that protects the powerful. By understanding the market as a battlefield, you can start to see through these narratives. You can begin to make decisions based on a clearer view of reality, not on stories designed to herd you in a certain direction. It's a tougher path, but it's the only real path to financial sovereignty. Thanks for watching. Understanding this pattern changes how you evaluate official explanations for market events. When authorities explain a crash or crisis, ask yourself, whose interests does this explanation serve? What alternative explanations would be more threatening to institutional power? What elements of the story receive emphasis and what elements are minimized or omitted? These questions don't necessarily reveal conspiracy, but do reveal the difference between narratives constructed for ideological purposes and analyses constructed to reveal truth. The challenge for individual investors is that acting on this understanding requires accepting uncertainty and discomfort. Following the official narrative provides psychological comfort. Experts assure you that markets are efficient, that regulation protects you, that long-term investing in diversified portfolios produces reliable returns. These assurances are pleasant to believe. Questioning them means accepting that you're operating in an environment structured against your interests, that authority figures may be unreliable guides, and that conventional wisdom may be carefully constructed deception. Most people choose comfort over truth. This isn't a moral failing. It's a rational response to cognitive limitations and emotional needs. We can't constantly question every assumption and evaluate every piece of information independently. We rely on authorities, conventional wisdom, and social consensus because doing otherwise is exhausting. Financial institutions understand this and construct narratives that exploit it. The 1929 narrative is particularly powerful because it offers a clear moral lesson that aligns with common intuitions. Greed is bad. Speculation is dangerous. Regulation protects the little guy from predatory elites. These lessons feel true because they align with moral frameworks most people accept. The actual lessons, that markets transfer wealth from trusting to sophisticated participants, that regulation often protects incumbents rather than outsiders. That conventional advice serves institutional interests rather than individual welfare, contradict comfortable assumptions, and require accepting an adversarial relationship with systems most people prefer to trust. Accepting these uncomfortable truths doesn't mean becoming cynical or paranoid. It means operating with appropriate caution in an environment that isn't designed for your benefit. It means questioning narratives rather than accepting them, understanding incentives rather than trusting intentions, and recognizing patterns rather than treating each event as unprecedented. These skills develop through practice and study, not through following conventional advice. The historical record provides abundant evidence for those willing to examine it. The 1929 crash wasn't an aberration caused by unique circumstances. It was an instance of a pattern that appears throughout financial history. The South Sea Bubble, the Mississippi Company, the Dutch Tulip Mania, the Railway Mania, the various panics of the 19th century. Each episode features the same elements: asset prices detaching from fundamental value, institutional encouragement of speculation, sophisticated participants exiting before the crash, and official narratives that obscure systematic wealth extraction while blaming individual irrationality. Modern technology hasn't eliminated these patterns. It's accelerated them. The 2021 meme stock phenomenon, cryptocurrency bubbles, SPAC manias. These episodes compress the boom-bust cycle into shorter time frames but exhibit the same fundamental dynamics. Social media enables faster narrative construction and more efficient herding. Options markets create leverage that dwarfs 1920s margin lending. Payment for order flow ensures retail traders execute at inferior prices. The specifics change, but the pattern remains constant. What's different about contemporary markets is the sophistication of narrative construction. In 1929, creating coordinated messages required controlling newspapers and having prominent figures make public statements. Today, artificial social media activity, algorithmic content promotion, and coordinated retail trading communities create information environments that can be manipulated with unprecedented precision. The average investor faces not just institutional advantages in information and execution, but carefully constructed psychological environments designed to trigger specific behavioral responses. Protecting yourself in this environment requires more than financial knowledge. It requires understanding propaganda techniques, behavioral psychology, game theory, and information warfare. You're not just competing against other investors. You're defending against systematic attempts to manipulate your perceptions and behavior in ways that benefit institutional participants at your expense. This is the reality that the 1929 narrative obscures. The lie isn't that the crash happened or that speculation was excessive. The lie is the framework that presents what happened as a natural consequence of individual greed corrected by appropriate regulation. That framework serves to perpetuate the system by suggesting it's fundamentally sound with appropriate oversight. The truth is that the system is designed to transfer wealth from outsiders to insiders through mechanisms that persist regardless of regulatory framework, because regulation is captured by the interests it supposedly constrains. Your path to financial sovereignty begins with rejecting comfortable narratives and accepting uncomfortable realities. Markets aren't neutral. Authorities aren't protecting you. Conventional wisdom isn't wisdom. These recognitions create obligation to develop independent judgment and accept responsibility for your financial outcomes. You can't delegate this responsibility to experts or trust that following standard advice will protect you. The people in that photograph from October 1929 trusted a system that failed them. Their descendants learned the wrong lessons from that failure and faced their own crashes in 1987, 2000, and 2008. Your generation faces the same choice. Accept official narratives and hope the pattern won't repeat, or develop the understanding necessary to recognize the pattern and position yourself accordingly. The choice determines whether you'll become another cautionary tale in the next crisis narrative or one of the quiet successes whose story doesn't appear in official histories. That photograph from 1929 should haunt you not because of what it shows, but because of what it represents. The moment when trust in institutions proved catastrophically misplaced, when conventional wisdom proved worthless, when the difference between those who understood reality and those who believed comfortable lies became obvious for everyone to see. Don't be in that crowd. Don't let the next crash be the moment you discover that everything you believed about markets and institutions was carefully constructed deception. The pattern is visible now for those willing to see it. The question is whether you'll look.